a quick conversation with somebody who looks at equities very, very closely. Shreyas Devalkar, Head of Equity at Axis AMC, Johnson right now on the show as well. Shreyas, great having you. Thanks for joining in. Shreyas, we were just talking to somebody on how Q2 numbers will shape up. Very likely will not be a strong quarter. Very likely that FY25 as a year will be pale in comparison to the previous years as well. Are valuations plus that a good enough reason to stay light and maybe not be into high beta names and look at value, or you're still very constructive on markets?
Thanks for inviting. And a great question. So obviously the market always is about earning growth, and earning growth in last year has been there has been slowness in the top line growth, but the margin has helped a lot in last few quarters. Now we are entering the quarters where that base effect of margin expansion, etc., is expected to fade slightly, and that's where overall earning growth for the market is expected to be lower. Now, in the context of valuation, definitely valuations are high across the board, barring private sector banks. I don't think there is any segment where the valuations are low. Actually, in last 4 to 6 months, market moved to perceived cheaper segments like IT and pharma and FMCG as such, but still there also earning growth is not that great. And while we have seen the re-rating in those stocks. So all in all, the observation is large caps are cheap, but with lesser growth. Mid and small cap are way expensive, but with better growth. And in that context, in such kind of market, we have seen that historically it leads to consolidation in the market. That pattern you are starting to observe in last 3 to 4 months in the market also. So I think it will be more stock-specific market than just try to allocate higher proportion to small cap and try to outbid the market per se.
Noted. Shreyas, I mean, the limited analysis that I've done seem to suggest that this quarter will be a washout. And sorry, I'm talking about the quarter too much. I'm not just asking you to comment on a quarterly set of numbers, but the notes seem to suggest that this quarter will be a washout because cement numbers will be unusually weak. I mean, Gautam Duggal of Motilal was saying that he in his last 6-7 years hasn't seen a 1% volume growth in cement YOY. So it's unusually weak. And then energy will have a high base effect impact. Otherwise, some of the other buckets seem okay. So I would love to understand, let's say, for example, on energy and cement, are you negative, or do you believe valuations bake in some of the worst things?
Sure. See, as far as these headline growths are concerned for market are concerned, generally every year in last 10 years, 15 years, there has been some pockets. So if you go back in last decade, there used to be write-offs by banks that used to take the market's earnings down. There used to be commodity sector, which used to take the earning growth down. So probably this time now it is a cement and metals or energy sector, what you are highlighting. So actually, as an investor, then what we tend to look at is, yes, where there is a very high earning volatility and lower earning growth. And now coming back to these two sectors in particular, definitely energy sector has its own volatility. And this quarter's what we have seen, there is a little subdued numbers which we have seen in this energy sector. So we are anyway always, so as a house, we have been always light on commodity sector, and that's where energy sector has been low. Coming to cement sector is interesting. Actually speaking, the volume growth for this sector has been in mid to high single-digit growth over a longer period of time, and probably in the recent past because of various reasons. So in last quarter also, where the reasons highlighted where monsoon, and sometime it is about election was also another reason in the last quarter, previous quarter. So there has been some reason recently in cement sector as such. But the sector is also, so long-term growth we have seen is mid to high teen. But major point which is happening in the sector is the consolidation, which is slow, but it is underway. And one should look at this sector from that point of view. It is slow, but it is underway, and that's where there is an opportunity in this sector.
Noted. The conundrum, and because you guys have done the traverse, right, Shreyas? Until 2020, you guys were famed for holding on to stocks which were the really high valued stocks because you bet on growth and it paid off beautifully. In select pockets, the market seems to be doing that yet again. I mean, I'm using the names as an example, not for asking you to comment, but a Trent or some of the others, right? Consumption-led names, some other pockets wherein the market is betting heavily on growth to continue and therefore willing to pay a premium, some EMS names, etc. How do you view the richly valued sectors? There are 3 or 4 out there, all of them different from each other, but I'm just using valuations as a common thread here.
Sure. Even so, would that you correlate with the current exuberance in some pocket of the market to even 2019? There used to be some pocket where there used to be very high exuberance. The broader point we try to look at is what is, first of all, since we are starting on the valuation note on a relative basis. So versus 2019 and comparing to now in 2019-20, probably the relative valuations were too high. Basically, one pack of market was trading at 8 to 15 or 20p, while other pack was trading at 50, 60, 70p. The difference today now is if this pack is trading at whatever 50, 60, 70, 80p, even part of capital goods, part of actually some of the themes in power sector, etc., they are also trading at 30 to 60 times P. So that relative trade relative valuations is probably what is different today than what it was in 2019. Now, when we look at this, there are always the general sort of rule of thumb per se, but whenever any company's valuation go above 40p, then generally it goes in a zone where that company need to do 2 things to create wealth over a period of time. That whether the orbit of that company is changing, whether the total addressable market is changing. That pattern was shown, that pattern is shown by multiple companies. Some of them, they're there. And if you look at, if that pattern is there and they can repeatedly do it, then they end up creating wealth even if they are highly valued at a point in time. So we have seen companies, they are replicating formats after format, the same success story. So that replication in multiple business models is where the real crux comes into the picture. So this is what we tend to look at when we look at expensive valuation. At expensive valuation, the bigger risk or the biggest risk I would call out is the disruption risk always. Because disruption may be because of some loss-making business model come up and then it becomes successful. The disruption will be maybe because of technology or anything. One need to be very careful of that. So if the disruption is there, then that expensive version just is troublesome. And the second part is obviously the earning downgrades, but that is applicable to any other companies, not only expensive companies. Earning downgrade, but then it has generally disproportionate impact on the stock prices. So generally, we tend to look at these 3 parts. One is whether the TAM is increasing, whether they are able to replicate their success story, what they have done so far. And on the other hand, whether there is a technological disruption, there is a competition who is coming, which is at the beginning appears to be irrational by way of entering as a loss-making strategy, and then earning downgrades. So one need to be careful about these things.
Okay. Where is it, Shreyas, that you are negative on? I mean, in terms of the reallocations that you would have done in the last quarter versus the previous 2 or 3, where is it that you are the most not constructive on, if you will, and why so?
So if you look at across our funds, we are generally underweight on financial lenders, I would say, rather than financial services. The lenders part of it is broadly we are underweight on then we have always been underweight on the commodity part, which is metal mining as such, so it is not as such today, and obviously energy part, which we discussed earlier.
Okay. Just wondering, would just one last question, 60 seconds, but would the private banks feature in this list as well? Because the opinion out there is starkly divided. Are you not so constructive in private banks?
So when I said underweight on lenders, so yes, we are underweight on lenders. Now, when it comes to private bank, as I highlighted earlier, that is the only pack where there is no re-rating on a 10-year basis. So in FY14, FY19, and FY current valuations are broadly similar. Actually, there would be in some cases de-rating. So valuation is definitely in their favor. But there, what you are noticing is the growth has come down both on the credit growth front and deposit growth front. So one need to be looking into it in more detail. Other part is the NIMs, which also is expected to contract. And so overall on the banking sector, or then I would call it as the overall lending sector. So important part has been the credit cost. So there has been element of increased credit cost on the retail credit front, because that is the only part which has been growing fastest, right? And there has been some credit cost increase which we have seen in last few quarters. So to be constructive on this sector, we need to be watching out for credit cost coming down and retail credit growth expanding.
Okay. Shreyas, so good talking to you today. Thank you so much for taking the time out and being with us. Really appreciate your time.
Thank you very much.
And that's about the time that we have on this edition of Talking Point. Thanks so much for tuning in.